Well, I think the two things central banks can do in the face of this coronavirus is, first of all, they can come out like they have hinted over the weekend that we will not let liquidity dry up in the market. So we will, pump the system full of cash, so there won't be any problems like we faced in 2008. The other thing they can do, of course, is cut rates, help to some degree to mitigate some credit risks. But overall, you have to admit the problem with the coronavirus is not particularly monetary in its nature. And so therefore, other than stabilising financial markets and signalling to markets that they will do all they can, they can't really do a lot to really help the economy, because we have to remember interest rates are already incredibly low.
Well, that's right. And if you haven't already gone out there and used and made use of those low interest rates, then I'm not entirely sure that you're going to suddenly do it now with another cut. So then it comes down to just a confidence booster to be able to say to global markets, we've got your back.
That's right, and it's all about mitigating the credit and the liquidity risk. In the end, central banks know they can't cure the coronavirus. They can't force households to go out to the shops and to spend money when they're fearful, obviously, of infection and so on. So, central banks are doing what they can, but they certainly do know the limitations of what they can achieve with these policy actions. But they are certainly going to try and do a shock and awe strategy. So I would guess at this stage that the US Fed will extend its QE program probably to the end of this year. They may even broaden it to beyond purchasing just short-dated Treasury yields. They may actually go out all throughout the whole yield curve. I suspect Europe may actually do the same. We also have rate cuts not only from Australia today but also from Canada, from the UK. So they're certainly not going to die wondering about how this virus will impact the global economy. But we do have to remember one thing. The global economy today is growing at a 4-year low, and that is before the impact of the coronavirus is known.
And the OECD is warning that global growth could halve from here. Come into the conversation here, Nance.
Yes, Matthew. I mean, just listening to you speak there does make me wonder what happens when these central banks are faced with a real financial crisis going forward, if they're going to use up all these tools on what is a health crisis turn to an economic issue.
Nancy, that's a great point. Simple fact is, for the last year and a half, we've been using QE, since September I meant, so the past 6 months or so. We've been using QE at a time when growth has been around trend, rather than 12 years ago when it was first used as a nuclear policy option when a depression threatened. And of course, the trouble with that is you're using all your conventional and quite a bit of your unconventional policy when times are normal. So it leaves very few bullets left in the gun magazine to fire when the financial system becomes strained, the economy goes into recession, etc. So what that will mean, of course, is that the policy pendulum will then switch from monetary over to fiscal. But the other thing I always caution our investors is that central banks are very creative and they are very determined, and as such, they will think of what else they may be able to do beyond rate cuts and what is now the traditional QE.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.